afternoon, everyone. Thank you for joining us today for our webinar to discuss uncharted waters. Today, we're going to be touching on some really great information for you, but just a quick introduction. My name is Josh Antis. I'm with the Community Relations Department here at California Coast Credit Union. And also just, I'll introduce Sandra in just a moment, but some housekeeping items to begin with as well. You notice that everyone's placed on mute for the duration of this presentation, but if you do have any questions regarding the material, any of the content that we're covering, or anything related to CalCoast at all, products, services, what have you, please feel free to type them into the question box, and we will answer those for you at the end once we've gotten through all of the slides and the presentation itself. We also have a evaluation survey that will come up at the end of today's presentation. It's an evaluation survey that allows us to get feedback from you, so please take the time to fill that out. We appreciate your feedback. It helps us to get better as we go along. And also, just so you are aware, because we do get this question a lot, the presentation will be sent to you in the next few days, as well as a link to access a recording of it. So you don't have to worry about trying to get the slides or trying to jot down all the information quickly as we move along. You'll have access to this later on. We're going to post it on our YouTube channel so you can check it out anytime you like. All right, so with that, I'm going to go ahead and turn things over to Sandra Torres. She is a certified financial advisor with California Coast Financial Services, and she does a lot of presentations for us. She's a great presenter. We're happy to have her here talking to us today. So Sandra, go ahead and kick it off.
All right, well, welcome everybody. I'm glad everybody was able to attend the Uncharted Waters, Navigating Stock Market Volatility in a Coronavirus World. We have a lot to cover, so let's get started. So what's happening in the markets? With all the events and the news and the market related to market volatility, and investors may be wondering, how are these events impacting my investments? Well, let's take a look. This chart, which is the S&P 500 index, is a cumulative return for 10 years, ending December 31st of 2020. The chart shows the growth of the S&P over the past 10 years. For those of you not familiar with the S&P 500 index, it measures the stock market performance of 500 of the largest companies in the United States. So let's take a look at it. Even with all the ups and downs in the past 10 years, the S&P 500 has had a return, a one-year return of 18.4%. Now let's take a closer look of the S&P 500 and the return from 2019 to 2020. We're also going to take a look at what has happened during the past 1 year, starting with what kicked it all off. So what happened in December 31st of 2019 was that the coronavirus was first reported from Wuhan, China. So that was the start of the crazy and wild ride that we had last year. Other important events that occurred last year was the Dow Jones and the S&P hit a major low in the market starting March the 23rd. So here we see how the market declined, and this decline happened in a little over a month. Let's take a little bit more look at what had happened in the market. Other events that happened in the market during that period of time is that we went into a recession starting in June. Other events that occurred during that period of time was that May 15th, we had a coronavirus relief package. So the government stepped in because of the drop in the market to be able to help because of the pandemic and what it caused in the market, which was a huge drop in the market. If we look at other notable events, we also had seen that other things occurred. So for example, we saw that we had a vaccine that happened in July, and then September, we had some devastating news. We had a count where more than 33 million people had been affected by the virus, and it killed over 1 million people. So let's go forward. In this agenda, what we're going to be covering is the stock market shocks in a historical perspective. We're going to be looking at what's going on in our heads during this period of time, and then also living with market volatility. Market shocks in a historical perspective. While most investors know that the market does go up and down and it moves in cycles, it's times like these when the markets are volatile and emotions are running high. A historical view can help us to put things into perspective. And while you've probably heard this before, while past is not predictive of the future, it does offer us some valuable perspective to what has happened in history. So let's take a look. Bulls and bear markets. If we're looking at the S&P 500 index and over a 50-year time frame ending December 31st of 2020, what did that look like? Well, let's take a look. Well, we can see by the graph the S&P has increased in value over that 50 years. But let's take a closer look. The bars that you're seeing on the screen, what that means is it's showing the bear market that has occurred during the past 50 years. So if we look at each of the bear markets, it has happened 5 times in the past 50 years. So what does a bear market mean? A bear market means that from the top of the market to the bottom, then there was a more than 20% drop in value. So we can see all the different drops from 43% to 30 to 47 to 55. So that was some bad times in the market. Those were what we call the bear market. Well, let's look at the other side. If we look at the other side, now I'm showing on the screen the bull markets. So looking at the bull markets, we can see, like for example, from September 30, 1974 to 1987, we had a bull market for 13 years and we were up 845%. So what does that mean? So what that means is that, so you can see the bull markets have lasted longer compared to the bear markets. And the average gain during the bear market was higher than the loss during the bear markets. So let's go to the next slide and see what that means. So if we looked at the bear markets, or the bull markets first, the average growth was 403% in the bull market, which means an up market. And that lasted 7 years and 4 months on average. Bear markets lasted on average 13 months, and the fall, which means the loss in value, was approximately 42%. So just in summary, it shows that bull markets have historically lasted longer than bear markets, and you generally make more money in the bear market cycles than the bear. You generally make more money in the bull market cycles than the bear markets. So let's look at the next slide. Market declines are part of investing. So as the market goes up, the market also goes down. So if we look at the S&P index over the last 50 years, from 1970 to December 2020, then the size of decline, so having the market drop 5% or more, that happens every 10 months. The last occurrence that this happened was August 2019. When the market drops 10%, what this is saying is that for 10% drops, that usually happens every 2 years. And the last time it happened was December the 18th. For the market dropping 15% or more, that happens every 4 years, and the last time it happened was December 18th. Market dropping 20%, which again, a 20% drop or more means a bear market. So bear markets, meaning a drop in the market of 20% or more, happens every 8 years. And the last time we had bear market was last year during the pandemic, and that was March of 2020. So what's going on in our heads? We are very emotional beings, and sometimes what happens is when we have market volatility, we don't always respond in the correct manner. So let's take a look at this. So this is us, and this is our brain. Our brains help us to make decisions. The front part of the brain helps us to make decisions, and usually we can do this quite well. Our brain helps us to decide, what are we going to eat? What clothes are we going to wear? What kind of toothpaste are we going to buy? And then what's the quickest route to work? But then we have this other smaller part of the brain, and that smaller part of the brain is what helps us act based on our emotions. So let's take a closer look. So this fight or flight. Remember the caveman when confronted by a saber-toothed tiger? Based on past experiences, the brain would tell the caveman that now might not be a good time to run. In fact, our brain is often associated with fight or flight responses. Letting our brain control our reactions when making financial decisions may lead to some undesirable outcomes and may have you do things that wouldn't be so positive for your financial decisions. So let's take a look. Let's go to the next slide. One of the things that we talk about is something called anchoring, which means we focus too heavily on one piece of information when making decisions. And how does that work? Well, anchoring influences performance expectations. Now, Franklin Templeton had conducted a survey. And what they did was they asked investors in the survey to tell us what is the average portfolio return expectations that they think that they would be receiving over a 5-year period. And the typical response was 10%. So for example, in the survey, the investors said that over a 5-year period of time that they thought it was reasonable to receive 10% per year. Well, let's see what happened the next year. So the next year, the market return wasn't 10%, but the investors actually received a 20% return. So this is what we call our anchor. So you would think that, remember, the investor anticipated returns were 10% for the 5 years, but since they had a 20% return in the market for the next year, their expectations changed. And this is how it changed. They all of a sudden adjusted their expectations and they thought, you know what, 10% is so low. So they adjusted their expectations to be 20% every year. So what they're doing is they're basing their expected return on what had just happened and throughout what their initial goal was, which was 10% per year for the past 5 years. Well, let's look at actually what happens. In this slide, we see that if we had $10,000 and we invest it for 30 years and we had an average annual return of 8%, then we would have earned $100,000 over that time frame. The only problem with that is that the market just doesn't move in a smooth manner going up. So if we look at the green line, is what the S&P actually performed during that same 30-year period of time. And you can see with the green line, it was pretty much a roller coaster ride. But during that time frame, you had received a 10% annual return, and your $10,000 over that 30-year period of time grew to $211,000. So where's our anchor? Our anchor is right here at the top. So in other words, when investors have that high where their money is at the most that they've ever made, they think that they're going to continue to make that same amount, and then it's going to keep growing by that amount. But what happens is usually when we have a high, then the market does correct, because remember, we have bulls and bears in the market. So it goes up and then it goes down. So then here is where investors can get discouraged because of they lost money temporarily and the market's down. So this is just a reality check that the market doesn't move in a smooth fashion, and generally you're better off looking at a longer term time frame. So let's look at the next slide. Loss aversion. The pain we associate with a loss is much more intense than the reward felt from a gain. So what does that mean? So what that means is we hate losing money. Really, that's what that means. We enjoy and we expect that we're going to make money in the market, but we just hate losing money. That's risk aversion. So what happens when we start losing money and fear drives investors to do things that they may not necessarily want to do? So remember the flight or fight? So this is the flight. Investor fears sometimes makes them do things that might not be the best thing over a longer term. So let's take a closer look at this. During the dot-com bust from March of 2000 to October 2002, investors were afraid. What they did was they sold $491 billion of their investments. And what did they do with it? They went to the safe haven, they put it to cash. Not only did they do that during the dot-com bust, but they also did that during the global financial crisis. Again, investors sold monies from their investments, which amounted to $943 billion, and put it to cash. So they wanted to avoid any additional losses, and investors moved it to what they perceived as a safe haven. So let's see what happens with that safe haven. So in this next slide, the perceived safety may come at a cost. So they decided they didn't want to lose any more money. We put it into cash or in the money market fund, and this is what happened. If we look back January of 2000 to November 30 of 2020. The money market yield, while it was higher back in 2000, we were getting approximately about 3%. But if we look at today, the money market yield, we're looking at about 0.07. So that's like 0.00 nothing. That's 0.07%. But when you look and take into account inflation, you're losing money. So that safe haven isn't always so safe when you take into account inflation. When you take into account inflation, you're actually losing money. So not quite the safe haven that people anticipated. So how do you live with market volatility? Well, there's 3 strategies that we can help investors live with market volatility, and let's review them. First thing to do is stay calm. First and foremost, the most important concept of investing is to stay calm and keep a long-term perspective. Well, let's talk about some strategies for that. Keeping a long-term perspective. This is the S&P 500 index starting from December 31st, 1970 to December 31st of 2020. And it shows the cumulative growth of $10,000 if you would have invested it in December 31st of 1970. Even with everything that has happened over that 30-year time frame, we can see all the various bear markets and disruptions, starting with the energy crisis, Black Monday, the tech bubble, financial crisis, and COVID. So we had quite a bit going on during this period of time, quite a bit of bear markets. But if we would have just kept the course and stayed invested over this, which is a 50-year time frame, your $10,000 investment in 1970 would have grown to $1.7 million. That's an average return of 10.89%. So even with all the bear markets, with everything going on, if you would have just stayed the course over that period of time, your $10,000 would have grown to over 1.7 million. That's what it means, keeping a long-term perspective. So let's take a look at how do we stay calm when all this turmoil and everything is happening in the world. Let's kick back, try to tune out some of that noise, and let's take a look. How do we do that? Well, first of all, if we look at this graph, it's showing S&P 500 from December 1970 to December 31st of 2020. Percent of time seen. Now, what does that mean? The percent of time seen, what that means is that how many times are you looking at your investments or your portfolio? If you look at your investments on a daily basis, then expect to see losses about half the time. So half the time, if you're looking at your account on a daily basis, you're going to have a gain. And then the other half of the time, you're going to be disappointed and you're going to see a loss. If you looked at it at a longer time frame, like let's say a 1-year period of time versus daily, then when you look at your account, you'll have about an 80% chance that you're going to have a gain and only a 20% loss. And as you extend out that period of time, if you look at it at a 10-year time frame, then your chances of having a gain is much greater. It's at 91%, and the chance of loss is at 9%. So what does that mean? That doesn't mean that you just don't want to look at your account for 3 years, 4 years, or 5 years, or 10 years. What that does mean is you do want to periodically review your account and then also discuss it with your financial advisor to make sure you're on track, to see if any of your goals has changed, and also to make sure your allocation is correct. But what this is showing that if you're looking at your portfolio too often, which is the percent of time seeing, then this may cause anxiety for you if you keep your eyes fixed on the daily market movements and you're not looking at a longer term time frame. So in other words, looking at your portfolio too much is not always a good thing either. I even have some clients that like putting the market and their investments on their phone, so they are not only looking at it daily, they're looking at it multiple times during the day. So be careful about how often you review your investments. It's okay to review, but you just don't want it to be where you're reviewing it all the time and you're creating anxiety for yourself. So tune out the noise. Okay. Next thing we want to look at is the tuning out the noise. Next thing we're going to look at is diversification matters. Another strategy that we use to help reduce the overall volatility in the market. So diversification matters. Diversification may reduce the overall volatility, but it also helps to provide a smoother ride through some bumpy markets. So let's see how that works. So why diversification? The reason why we diversify is because winners rotate. As we can see on this graph, it's an annual total return of different asset classes from 2005 to 2019. So as we can see in 2005, EM, which is emerging stocks, had the best performance. So that's who was on top. The worst performing sector was global bonds. Now, if we were to look at the top performing sectors in 2005, 6, and 7, that would be the emerging market sector. So let's see. Oh. Okay, so if we were to look at this sector, and let's say in 2005, 6, and 7, you were feeling pretty good if you invested in emerging stocks. But if you had put your money into emerging stocks starting in 2008, then emerging stocks in 2008 dropped by 53%, which means you would have lost 53% of money. So you wouldn't have been feeling so great at the end of that year. So winners rotate. So you can see emerging market stocks isn't always the top performing. Sometimes it's top performing, and then sometimes it's the bottom. Let's look a little bit closer. So why diversify? If we look at the growth of $10,000 invested annually between 2000 and 2019, the three strategies that we had was either chasing the winners, whoever did the best last year is who we would invest in. So the total investment we started with was $200,000. The value of the portfolio increased to $438,000, and that was an average return of 6.99%. The investing with the losers, meaning you invested in the worst performing asset sector, had increased, but it didn't increase as much as chasing the winners. But still, you got a pretty good gain because it ended up being $416,500, which was still pretty good. But if you use asset allocation as a strategy, which is just meaning that you're investing over the different asset classes, so not just the winners, not just the losers, but you're investing over the different asset classes, then that actually ended up giving you the highest return for the value of your monies, because then it was $469,285 that your money grew to. So asset allocation is important, and asset allocation can help to smooth out that roller coaster ride, and then also it can provide you with a higher return. Remember your strategy. While it might be tempted to pull out of the market during volatility, it's important to stick to your investment strategy. Remember your strategy by staying invested. This graph shows the 20-year period of time for the S&P, and it shows the blue bars, which is the largest decline from peak to trough, and it also shows the green, which is the returns for each of the years. So for example, in 2001, for that year, we had a negative or a drop of 12% in the market, but our biggest drop during that same time frame was 29%. If we look at 2003, the market ended up 29%, but sometime during that year, we were at a loss of 14%. So all this says is that volatility, while challenging, can even happen on a year-by-year basis, but the calendar returns, as you can see, there's more green on the top and more positive returns is greater than the market declines, which is the negatives on the bottom. So even during a calendar year, you may end up the year, like in 2003, at a 29% calendar positive return, but during that year, it also fell by 14% from the top. So even on an annual basis, it can be very volatile. So what else can help us? What other strategies can help us with market volatility? And one of the other strategies we use is dollar cost averaging. So what is dollar cost averaging? Dollar cost averaging helps investors to cope with volatility. So let's see how that works. Dollar cost averaging means that you're taking a set amount, which is in this illustration, $500 per month, and you're investing it in your investments. So what is happening is when the market price or the market goes down, like in the January illustration, we're investing $500. The share price started at $10, but now the share price is at $9. What that means is the market then is down. For that month, we're able to purchase more shares, $55 or 55 shares, 0.6. In February, we're investing the same $500, but the market went back up. The share price or the market price is now $10, so we're only buying 50 shares. So what this means is that over a period of time, because you're buying more shares when the market is on sale and less shares when the market is higher, your average price of the share was $10, but your average cost, because you're able to buy more shares cheap and less shares more expensive, you're actually buying the market cheaper by dollar cost averaging. And that's where we get the average share cost of 9.77. So the result is you're actually buying the shares, your overall cost is cheaper during that dollar cost averaging. What is also good about dollar cost averaging is that it helps to reduce your anxiety about investing when the market drops. For example, if you are investing it automatically into your investments and the market drops, then it's automatically going into the investment. Whereas if you didn't have the dollar cost averaging and the market drops, then you might have thought, oh, I don't want to invest now because I might lose more money. So that might prevent you from buying the market when it was on sale, when the market was down. Because what you want to do, remember, investing 101, you want to buy low and in some cases sell high. So you don't want to buy high and sell low. Dollar cost averaging helps us to invest on a regular basis and take advantage of the highs and lows of the market. Jumping in and out of the market can be costly. What if you thought you had that crystal ball and you knew when was the right time to sell out and the right time to get in? Or what if we just stayed invested? So let's take a look at that. Over a 20-year time frame, if we looked at the S&P 500, staying fully invested, you would have had an annual return of 7.5% over that 20-year time frame. Let's take a look. If you missed 10 of the best days during that 20-year time frame, then your performance wouldn't have been 7.5, it would have been 4.57%, and all you did was lose or miss the best 10 days. in that 20-year period. Well, what if you miss 20 of the best days? Then your return would have been only 1.86. What if you missed the best 30 days during that 20-year time frame? Then your return would have actually been a negative of 1.5%. So sometimes jumping in and out of the market can be costly because you would have to time it just perfectly to be able to beat just the staying fully invested. So let's look at another chart. This is the S&P 500 again over a 20-year period ending December 31 of 2020, and it shows the 20 worst trading days, and then on the other column shows the 20 best trading days. So let's see how this works. As we can see in the blue, the worst trading day was March 16th of last year, and the market was down 12% in one day, and that was during the pandemic. So if we would have sold out on that worst day, which was March 16th, then we would have missed the best trading day, which was the next day. Because it went down so much, the best trading day was March the 17th. Let's look at some more days. March 12th of 20, the market had a drop of 9.5%. And look what happens. The next day, the best trading day, or the best time to buy, was that next day. And we can see it continuing kind of on and on, where sometimes where if you get nervous, you go for a safe haven, you have the worst one-day drop, or in this case, the worst 20 trading days. Usually you'll miss out on the 20 best days, which is the next day. So it's very hard to time the market. So some key takeaways. History has shown us that while markets react to shocks in the short term, they tend to reward patient investors over the long period of time, or the long term. Emotions do affect our decision-making ability in times of market volatility. 3 strategies to live with market volatility are stay calm, diversification matters, and to remember your strategy. Why are you investing? What was your long-term goal? So don't let short-term volatility send you off track of your long-term goals. So let's look at what will 2020 or 2021 hold for the markets. If we were to look ahead, let's say into this year, what are the things that we know for certain? Some of the things that we know for certain going forward is that it's difficult to predict the markets, and the market volatility is just part of investing. We've seen that graph where the market goes up and down like a roller coaster, and we don't think that that's going to stop. We continue to think that that will continue moving forward. But you don't have to go it alone. My advice is to seek the help of your financial advisor and to have somebody help you with it, so you don't have to do it by yourself. Coaching makes a difference. Your personal trainer will help you build a long-term strategy, keep your emotions in check when the market is very volatile, and help you to stay on track. So who is your personal trainer that can help you? Well, your personal trainer is your financial advisor. Your financial advisor can help you build a long-term strategy. They can help you define your goals and objectives, what your time frame is, and then also what is your risk tolerance? How much risk are you willing to assume, and how much risk are you willing to take? The financial advisor can also help you to keep your emotions in check when the market is going crazy, if the market's up and down. They can help you to reevaluate your situation. They can sit down with you to make sure that your portfolio is still the best for you, or if you need to make any changes. Your professional can also help you to stay on track to meet your goals. So do we have any questions?
All right, well, thank you, Sandra, for all that great information. Looks like we do have some questions coming in. Let's see, so Lynn would like to know if, let's see. Oh, I'm sorry, no, it's David. Should we have any exit strategies? Some brokerages, sorry, I can't read the whole question here, 1 second. Oh shoot, I can't read the whole question. It's blocked for some reason. Some brokerages advise to set, darn, I can't read it. Here we go. Let's see. So should we have any exit strategies? Some brokerages advise to set stop loss for stocks.
So that's a good question. What I would say is to sit down with your financial advisor to go over your plan and your goals and objectives. Stop losses are a strategy, but sometimes that can work for you and sometimes it can work against you. For example, a stop loss is usually something that you put on a stock. And let's say the stock's trading at 50 and you put in a stop loss order that if it falls to, let's say 40, it automatically sells you out. Sometimes the problem with the stop loss is that if we have a rapidly declining market or the market ends up much lower, instead of selling out at 40, you may be selling out at 20. So you have to be careful with stop losses. But what I would say is that instead of focusing on just one part of the aspect of it, you'll want to talk with your financial advisor about how that works with your overall investment goals and objectives. So I would say make an appointment with your financial advisor to discuss whether that strategy is a good strategy for you, because everybody's a little different.
Sorry about that, I muted myself. Thank you, Sandra. Another question is, what type of investments would you suggest for someone who will retire in 3 to 5 years?
So another good question, but another one I would say, because I don't know enough about the person, that you'd want to sit down and then go over some of your goals and objectives, and then also your tolerance for risk. But we do have different types of investments for different periods of time and for conservative investors. So we do have the different investments for that time frame and for that type of investor, but we need to know more about your own situation to be able to customize it to you.
All right, and this is an interesting question. How do you find a financial advisor that doesn't work on commission?
Oh, that's great. You could come see California Coast Financial Services. So we do have programs where we don't work on commissions, but we can work on what's called a percent of assets. So there's different options that are available. So come see us, come make an appointment.
And I did put in the chat box, there's a link to the website where you can set up an appointment to talk to one of our financial advisors, either Sandra or someone that might be within your territory. We have a whole team that's available. And like Sandra was saying, you can talk to them. It doesn't cost anything to come in for a visit or, do a virtual visit. And we'd love to see you. Okay, so.
Yeah, we're a great resource. Even if it's just getting a second opinion or answering some questions, always happy to help. Other advisors are great advisors as well. So that's Kyle Johnson and Ray Perez is the other two financial advisors with California Coast Financial Services.
And you're right, all three of you are great. I've worked with all of you before. So, so also, there's a question from Naomi that says, guidelines for stages in life to assess your investments. Does that make sense? I think she's asking what kinds of guidelines can you have for the stages in your life to assess your investments?
Yes, so there are different stages in your life. If you're in a stage where you're accumulating wealth, then that's a different set of investments, different goals versus, and that might be somebody that is just starting out. Maybe they're just starting to accumulate their wealth and starting to put monies in savings for retirement, and they might be 20, 30 years away from retirement. And that could be very different than from somebody that is later in life and maybe on the verge of retiring. So there's different stages depending on where you are in life. So there's different investments that are geared to different types of investors and where you are.
Yeah, she added another comment. She said 30s, 40s, etc. Age-wise, I believe.
Yes. And here's another way that we can help, because we can evaluate where you are in your stage of life, and we can offer some advice on what can help you or benefit you. But again, we would need to know more about you, your time frame, risk tolerance, and preferences for investments, and then we can give you some advice.
All right, what about pension rollovers? Do you help with those? Gloria wants to know.
Yes. So we do have quite a few members with the credit union that do receive pensions, and we can help with a rollover. So what that would be is it would be called a rollover IRA. So we do that, and we can help you. And one last thing, the nice thing about rolling over your pension, what that means is that the monies continue to be tax deferred. So you can roll it over, you're not taxable on just transferring it, or what we call rolling it over into a rollover IRA. It continues to be tax deferred. We can help you.
All right, and Sandra, is there a screen that has your contact information on it after this one?
Well, let's take a look.
If not, what I'll do is I'll put Sandra's email address in the chat box, so you'll have that available. But again, if you would like to schedule an appointment with Sandra or anyone else on our CCFS, as we call it, Calico's Financial Services team, you can go to the link that's in the chat and schedule an appointment. I also encourage you to explore the other resources that I included there. We have our YouTube channel where we have all of our webinar recordings. They're all housed there. You can go back and watch various webinars on all kinds of different topics financially related. And we also have a very great tool that's powered by Enrich. It's a financial wellness platform that gives you a plethora of videos and courses and tools and articles, all kinds of great things that can help you along your financial journey. And it's all free. Everything we do is for free. As a credit union, we are not for profit. We take all the money we make, we put it back into products and services that we offer to our members, which is you. So check it out. I encourage you, if you have any questions at all, your answers will be there. But like I said, I'll also put Sandra's info in the box here and make sure you have that. Let's see. There was another question from Richard. If I already retired, what do you suggest to do with $100,000 savings?
Come see us, make an appointment. We need to tailor that to you. What's right for you may not, or what's right for other people may not be right for you. So make an appointment, and then we can help you with what your goals, objectives, time frame, risk tolerance, and then we can give you some options on what may be the best for you.
All right. And Lynn would like to know what kind of investments are most secure.
Generally, the most secure investments would be certificates of deposits, because they're either FDIC or N2A insured. But remember, we also talked about that they're the most secure as far as because they're a guarantee from the government, but we also want to look at if they're going to keep up with inflation.
And what, do you know what the rate of inflation is right now? Is it the typical, was it 1 or 2%, or is it, you know too much about that right now, Sandra?
Yeah, so usually, typically, inflation was running in the 2 to 3% on average. And then it has been, moving up and down a little bit, but that's still pretty much the case. It's still inflation, even though they're anticipating inflation may be higher, we're still looking at that in the range of that 2%, 1 to 2% range.
All right. Well, it looks like we don't have any other questions at this time, so just want to thank everyone again for joining us today for our webinar. You can visit our webinar page on our website, and the April and May webinars that we have scheduled are listed there. You can register if you'd like. We actually have a special webinar coming up this month on scholarships. So if you have any students in the family that are looking to apply and search for scholarships, we'll be discussing that on March 31st. So that's also on the site. You can sign up for that and register today. So I encourage you to visit the webinar site and take a look. But for now, I want to thank Sandra for presenting today and for answering all of our questions. A lot of great information. And again, we'll have this up on our YouTube channel in the coming days. So if you do want to check out the recording of this session again, you can do so. Sandra, any closing thoughts?
No, thank you everybody for tuning in, and I hope you found some of this information helpful. And we're always here, California Coast and California Coast Financial Services. We're here to help you.
All right, well, everyone stay safe, be healthy, and we'll see you next time. Thank you so much.
Thank you.